Since 1991, I've tracked the Palos Verdes and South Bay real estate market every single week, 1,836 consecutive weeks. And this week, that data set flashed a pattern it has shown only 7 times in 35 years. The last 2 times, October 2011 and April 2020. Stay with me because whether you're buying or selling on the peninsula, this one matters. All right, so I'm George Foshin with Call Realty Best Palos Verdes Homes. For over 45 years, I've logged this market daily, and every week I run what I call the derivative calculus price momentum analysis, applying velocity and acceleration mathematics to real MLS activity. Today I tested a simple question. Do 2 demand indicators actually predict where the average closing price goes next? Not vibes, statistics. Indicator 1, new pendings divided by new listings, pure demand versus supply. How much of the fresh inventory is the market absorbing? Indicator 2, closings plus pendings divided by expired and canceled listings, success versus failure. Are transactions completing or are listings dying on the vine? Here's the test across all 35 years. I sorted every week into 4 buckets by demand strength, then measured what prices did over the following 12 months. Weakest quartile, prices fell, median minus 1.6%. Strongest quartile, median plus 12.8%. And the 2 middle buckets landed exactly in between, in perfect order. A 14-point spread, perfectly monotonic over 3.5 decades. The correlation strengthens the further out you look. 0.48 at 6 months, 0.57 at a year, 0.63 at 2 years. These indicators don't. So where are we today? August 16th, 2026. Both indicators are rising. Pendings to new listings up nearly 8% year over year. The closing price, flat. 1.55 mil on the trend line, up less than 1%. Demand strengthening underneath a flat price. That's positive convergence. Only in 1993, 96, 2008, 2009, 2011, 2016, and April 2020. The honest read, even when it complicates my story. In the 12 months immediately after this signal, prices historically went roughly nowhere. This is a floor detection signal, not a rocket launch. But look what came after those floors. 1996 predicted the late 90s boom. 2011 predicted the 2012 to 2018 run. April 2020 preceded the strongest surge in peninsula history. The signal says downside is being absorbed. The payoff historically arrives in 12 to 36 month window. And the calculus agrees. First derivative, price velocity, positive at about 8,700 per week. Second derivative, acceleration, just crossed back above 0 in late July. That's a genuine inflection point. The deceleration we saw through early summer has stopped. So what do? Buyers, flat prices with strengthening fundamentals is historically the window, not the warning. Negative divergence, the pattern that precedes real declines, is completely absent. You have negotiating leverage today. The data says you may not have in 18 months. Sellers, well-priced homes are going into escrow at 3-to-1 success ratios. The market is punishing overpricing, not selling. Price to the trend line, win your first 21 days, and if your timeline is flexible, really flexible, let's talk about what 2027 and 2028 might look like. Full reports, charts, forecast, and a devil's advocate section on how I could be wrong in the link below. Want this run against your home or your search? Call or text me, George Foshin, 424-722-9136, or book directly through my Calendly link. It's in the bottom of every one of my websites. It's the blue Calendly tab. 35 years of weekly data, 0 guesswork. I'll see you next week.